All right, welcome everyone back to URS Capital Partners quarterly update series. This is now our 13th quarterly update since the beginning of 2023. So we're going to cover Q1 2026. I'm here solo for this one. Chris Gorman, our Managing Director of Investments, his wife went into early labor this morning. So we're as we're filming this, you never know, there could be a baby Gorman on the way. But excited to keep going with the same format. It's a 3-part series. It's a little lengthy, but it's on our YouTube channel. We have each part broken out so it's easy to follow. Intro is basically going to be our kind of market summary from a macro side, what we saw in the quarter. Second part is our main KPI review, all of our portfolio KPIs for first quarter. And then third part's a little bit of some recent announcements and looking forward. So appreciate you taking the time to review this and watch this. If you ever have any questions, please feel free to reach out to myself or Rebecca at urscapitalpartners.com. So just a quick summary. Most of you know us by now, but for those of you that might be watching this for the first time, Urso Capital Partners was founded back in really 2008. Our first apartment acquisition was in December of 2009. So since then, we've gone on to acquire over 5,800 apartments, primarily value-add, opportunistic, core plus. We added to development to our platform in 2019. Since then, we've gone on to develop almost 1,300 apartments. We've sold 23 properties to date with an average IRR of just about 33% and an equity multiple of 2.07. We built our business 100% on private capital. We're extremely grateful for the relationships that we've forged over the last decade plus now, which is crazy, almost 2 decades coming up. But many of our investors that are with us today were with us on our very first apartment deal. We've been very fortunate. We were very active sellers from, I'd say, 2019 through 2023. We began acquiring again systematically in the beginning of January of 2024 as the market's been going through the reset and the dislocation that's out there. We saw it as an opportunity for us to acquire higher quality assets at a very attractive basis and put more of a mid to long view on. And we've been able to do that through a pretty challenging environment because of our tremendous investor base. So as we continue to grow, we're going to have some exciting opportunities for new investors to join us, accredited investors, of course. And that's part of the business that we really love and value tremendously since the very, very beginning. We try to do things like this. We're constantly trying to improve our investor relations, our reporting, and our transparency. So in addition to URS Capital Partners, we have our property management division, which is URS Properties. So we are vertically integrated. Our in-house management team is exclusive for the URS portfolio. We don't do any third-party work. And that's really more of an extension of our investment platform. It gives us the ability to have direct and immediate controls on our operations of our portfolio. We're very fortunate. We've got a great COO, Jen O'Brien, who sits in Charlotte, oversees the day-to-day. We've got a handful of fantastic senior regional managers, director of optimization that's been with us for about 11 years. And then the rest of our team, which is about another 50 plus employees, is scattered throughout our sites. And this really has never been designed to be a profit center for us. It's just more of a way, again, for us to have total control of the performance of the properties and be able to react quickly and swiftly to challenges or issues that may surface, and also capitalize on opportunities quickly that present themselves on the operations side. So in terms of geography, we remain relatively focused. A lot of folks think that we play all over the country, but we remain relatively focused on markets where we either have a presence or have had a presence in the past. Right now, it's North Carolina, South Carolina, Tennessee, Georgia, Portland, Maine. We developed up in Portland, Maine back in 2019. It was our first ground-up deal. We still have today 256 apartments. Love the market. Would love to do more there as opportunities present themselves. But, these are the markets that we've got a deep history in, both relationships. We know them fairly well. We've got boots on the ground. in addition to these markets, I'd say we played in and out of Jacksonville, Tampa, and that is a priority market for us over the next, call it 12 to 36 months. We think Jacksonville, Tampa, specifically Jacksonville, is probably one of the markets we really like to focus our energy on to get back into. So, for us, it's important to, given that, we're vertically integrated, when we get into a market or back into a market on a first acquisition, we typically try to put the energy there to identify additional opportunities there. It gives us efficiencies and creates a little bit of scale. So these are the markets that we're playing in today. I won't say we'll never go outside that box because we are opportunistic, and especially in a highly distressed situation, I think we would travel outside our geographic footprint. But for today, this is where our focus remains. So now just touching on some of the market stats for Q1 2026. This is a slide we've been using now quarter over quarter. I think it does a good job touching on kind of all the key metrics and geographies. First from a macro perspective, we're seeing occupancy start to, normalize again. Over the last year, we're essentially down, just over not even a percentage point on occupancy. So while supply has remained elevated and lease-ups are rampant still, even as supply is dwindling, we are seeing occupancy remain fairly healthy. So in addition to that, average rents are pretty much down about 0.5% on a national level. In the first quarter, you're seeing them tick up about 0.4%. And you could see here in geographic wise, Midwest, leads the pack, lowest supply, in terms of supply, that was probably the least supplied out of all the geographies over the last 5 years, specifically, 2021, 22. Northeast remains fairly tight as well. South saw a little bit of a negative dip there of about 2.1%, not inconsistent with what we're seeing in our portfolio. West Coast down about 0.4%. But we are starting to see, and you'll see this on the next slide as well, demand is remaining fairly healthy. Quarterly demand did outpace supply. So we had 93,000 units absorbed and 75,000 units delivered. So we're seeing the pendulum slowly start to move in the right direction. But this takes time. We knew it was going to take time. We're coming off of 50-year highs in new completions, basically, or deliveries in the multifamily space. So it's not something that's going to be absorbed overnight, but we have seen consistent demand as supply begins to normalize. So we saw supply at, over the last year, rolling 12 months, 366,000 units. Annual demand was 303,000. Now on a quarterly basis, you're starting to see that, again, demand outpace supply. We believe all of 26 is going to continue to be, a little bit of a dogfight. Concessions are going to be prevalent, most likely, in most markets. All markets and submarkets are not created equal. I think some are going to rebound quicker than others. For example, at Portland, Maine, we rarely have to use concessions there, but a very tight, undersupplied market. Other markets, some markets in and around the Carolinas, it's the norm. You need a month to 2 months, and in lease-ups, you're seeing 2 to 3 months of free rent to get through that supply side. But when you get to the other side, the numbers do look very healthy looking outward. And that's always been our thesis since we started acquiring, is that we knew 24, 25, 26, it's going to be tough. We probably were early on some deals, but I think overall, we're really happy with what we bought, and nothing is extremely surprising operationally to us in terms of what we're seeing in real time. But again, when you look outward and you see completions falling off materially in every one of our markets, we know that we have to kind of just keep putting one foot in front of the next. And, when times are good, you tend to forget that they can be bad. And when times are bad, you tend to forget that they can be good again. we're going to start to see that demand continue to outpace supply as more of these lease ups get stabilized and completed. So this kind of, reinforces a little bit of what I was touching on. Nearly 75,000 apartments wrapped up construction in Q1. And you're seeing the trend line here is the average, and orange bar here is Q1, and you're seeing it revert back to kind of the mean and even down from some of the prior averages. So, you look at 24, 23 leading into 24, everything's lining up the right way. Lease ups of 200 to 300 unit apartment complexes, outside of, the euphoria of post-COVID, the norm is not, for those deals are not going to be stabilized in 12 months. A 300-unit apartment complex is going to take likely every bit of 18 to 24 months, depending on the submarket. So if something was began delivering in 24, that's going to not stabilize until the end of 26. But the important thing for us is that we're seeing the new completions come down tremendously. So when you're looking outward in terms of 27, 28, 29, 30, that's really what our entire thesis on acquisitions has been predicated on, is that we know it's going to be a challenging time as we work through it, but the fundamentals and the data is showing us that demand is remaining healthy and supply will be diminishing back to normalized levels, even below historical levels in some markets as well. So on the capital markets side, this has been very interesting. I don't think anybody underwrote a war in Iran or a attack on Iran. If you look at prior to that event, rates were beginning to pull back, both the long rates and the short rates. As a result of that, and oil and things that are a lot more complicated than my pay grade will allow for, we've seen rates tick upward again pretty meaningfully. If you look at the chart here, from the 5-year up, 12 bips, that's close to 396, 398 today. 7-year up again, about 13 basis points. 10-year up about 7, and this is over the course of the year. 30-day SOFR short rates have kind of normalized. We don't know when and if there's going to be another cut this year. I think as long as this Iran stuff is going on, it's probably not going to happen. We don't like to assume, we know when and what's going to happen with interest rates. The reality is we don't know. We try to make smart decisions based on where the market is today. We're not big on leverage, as you can see here. Our average loan to cost on the stabilized portfolio is about 65%. The deals that we've recently acquired, 61%, and our developments are even less at about 57%. So we don't play, with mezzanine or preferred equity or stretch seniors. That's our hedge on rates. Is very modest leverage. We believe that gives us staying power to be able to navigate through challenging periods. We are very, very bullish long-term on our space. We think the affordability gap is going to continue to widen in the country, but we have to keep an eye on rates. It's a meaningful part of our business. We stay very close to it. There's a plethora of liquidity in the debt markets for multifamily specifically. So lenders are very bullish on the space. There's just as much liquidity as we've seen in any other environment over the last 14, 15 years. Obviously, more liquidity now than ever, given private credit and alternative lenders that have really gotten into the space aggressively. So we're seeing spreads tighten up on what we'll call your bridge lending or floating rate financing. We're seeing spreads on SOFR for high quality new construction product that maybe isn't stabilized yet. You can see spreads in the 130s to 150s. For your, opportunistic value add deal that's got some sort of operational distress attached to it, you're probably in the low to mid 200s and I'm talking in the 60, 65% LTC range there's lenders out there, we get term sheets that will go up 85, 90%, but they're going to be at a SOFR, 350, SOFR 400. That's not our style. That's not our game. We're seeing the banks get very aggressive again after taking a hiatus for about 2 years. The banks have come in very aggressively on either 5-year money or floating rate, utilizing a swap. They're leaning in and competing with the agencies for the first time in a very long time. Life cos are very active, and obviously your debt funds are extremely active. So there's no shortage of liquidity on the debt side for deals that make sense. And I think especially quality at an attractive basis, the lenders are behind that thesis. Their collateral they feel is very well protected at the basis that it's being acquired at today at, call it anywhere from 20 to 30%, if not more, below what you could build that same product today. So in terms of deal volume and activity for the first quarter, so we use deals originated, deals underwritten, deals offered, deals purchased, and pipeline deals sold. So that means deals that we brought into the pipeline at some point over the last 12, 24, 36 months that sold in this quarter. So in Q1, we brought 55 deals in, and that means phone calls to myself, Chris Gorman, Zach, of, hey, why don't you guys take a look at this deal? Lender wants to sell this at their debt basis, or I have a seller with a loan maturity coming up, a fund at the end of its life cycle. These are things that they come in the door. We do kind of a scrub down initial, like, hey, that's not for us, too big, too small, don't like the location, not in that market, whatever the case may be. And then from there, we filter into underwriting. We did full underwrites on about 30 deals this quarter. We offered on 4. We didn't buy any this quarter. So we did have 2 closings, which you'll see, but those were originated prior to in Q4 and Q3 of last year. And relative to Q4, we brought in more deals, underwrote a little bit less, offered on a little bit less. I will tell you, we're going to talk about it later on kind of looking forward, but we are seeing a lot of deal flow, on a consistent basis. We're getting a phone call a day, a deal a day. You could probably average it out to that's just kind of a text, an email, or a phone call. And the challenge, not challenge, but both challenge and opportunity is being disciplined in terms of where to allocate our time. Who's an actionable seller? We're getting a lot of calls on, lender wants to sell at their debt basis. Okay, that's great. What does that translate to? Well, a 4.5 cap. But there's a lot of upside, but a lot of times there's not a lot of upside, and they're just trying to sell it at their debt basis so they can get out whole. And they're not necessarily in a rush to sell. The sellers that we've been seeing that have been exciting are committed sellers to transacting in this market. Whether that's a private owner that's had a deal for 10 years, is up for a loan maturity, is winding down their portfolio, retiring, not really multifamily specific anymore, to larger companies or funds or REITs that are in liquidation mode and have committed to selling out their portfolio. The lender side, we're seeing more motivation on the deals that lenders have had for a year or 2 years now, versus the ones that are coming up on a foreclosure and they're trying to just make something happen prior to the foreclosure. There's not as much motivation for them to take a haircut there. So not going to digress too much on that side. I could probably spend an entire hour on that. But next up, we have the activity per market. So this is what we track in terms of where our focus is. You could see this is, everything from, not going to go through every market here. You all can see it, but top markets for us in terms of deals coming in the door were Charlotte, Charleston, Greenville, Atlanta, very little bit none in Portland, Asheville, not too much, not surprising. Raleigh, Durham, starting to see more deal flow there. We're really trying to be strategic. I think on a go forward, we had a meeting this week about where to focus our energies. I've talked to several of our investors about this, looking outward. Okay. The problem in our space with data around new development and future supply, there is no great source still to this day. So there's the top 2 or 3 data providers, and you kind of have to take that, and then you have to do a lot of legwork around it. Their forecasts on future completions based on information that they're culling from either permit submissions or zoning approvals, etc. But it's still not perfect in terms of the status of those deals. So in our markets, especially when we're getting close on a deal, we're looking at the supply pipeline in a 1, 3, 5, 10-mile radius. And we're getting in the habit now of Zach is literally going to the market and driving these sites that are on the forecasted completions list and getting an update on where they're at. Does it look like there's any movement? Some say that they're planned, and then we'll get there and they're already doing site work. Others will say that they're going to be delivered next year, but there's been no movement at the site. So it takes a good bit of work, but our focus is really on taking the data that we have access to and focusing our energy on markets where future deliveries over the next, call it, 24 to 36 months are sub 3% of inventory growth. There's still markets that are tracking 4, 5, 6% inventory growth over the next, 1, 2, 3 years. So we're trying to be really cautious on where we're looking on a go forward. So we're going to be looking at, more Atlanta, more Nashville, more Jacksonville. And we're going to continue to look in our markets because every sub-market is different. But in terms of focusing like top line energy, where we want to try to build this pipeline out and where you should start to see activity per market moving is kind of in that Atlanta, Nashville, Jacksonville top line baskets. And then we're going to always look where we have a presence because we know those markets well. Just to say like Charlotte has a, forecasted completion still of 4 or 5% for next year, but Charlotte's a big market. Mooresville, where we're developing, their forecasted completions is like less than 1% of inventory when you look out 2 years because they put a moratorium in certain segments of the market. It's very challenging to get approvals. We can go to other parts of Charlotte, like Noda, for example, might have 4 or 5% of inventory growth. So I'm digressing a little bit. Chris usually does this slide, so I'm doing my best here. But just wanted to give you some insight on how we focus our energy across our markets. And then next up, this is the transaction volume per market. So you can see quarter over quarter, we've seen, fairly flat, plus or minus. So Q4, there's about $1.6 billion of transactions closed within our markets. Q1, 1.597. So very close. Charlotte up pretty materially. 454 million of transactions closed. Atlanta, not surprising. The top 2 markets in the Southeast leading the charge. Atlanta, 400 million in line with prior quarter. Nashville up 250 million. It was 200 million last quarter. Charleston, not surprisingly, down. Tighter market, smaller market. Raleigh-Durham down pretty meaningfully for a bigger market. And Winston-Salem up pretty materially for a smaller market. So we look at this, and then we have in our pipeline, we have every one of those deals that make up the numbers that are in here. So when we're underwriting, we want real-time reference points, and specifically as it relates to the type of product and submarkets that we're looking at new opportunities in. As you can see here on the next slide, we're now looking at average pricing. We break the data down even further to pricing per vintage within the market. And again, in our pipeline, we have all of the details behind those sales. The owners, what the debt was, what the average rent was, what the occupancy was. And in some instances, when we can, if there were deals marketed, we go to the brokers who sold those deals and we ask them for their financials at the time of sale. So we can now underwrite those and put a cap rate on it that's real, not just printed in CoStar or told by a broker. That's based on the financials. So we can look at that as we're underwriting to get a sense of where the market is looking at deals. So you could see, I'm going to use just Charlotte, for example, because it had 9 total sales, how it was broken up. 1 sale in 1970s vintage, none in the 80s, 1 in the, I know it's probably hard for you guys to see, but 1 in the 90s vintage, 1 in 2010, and 6 were 2020 and newer. So there's definitely an affinity. So 7 of the deals were 2020, 10 and newer out of the 9 transactions that closed in Charlotte. So an affinity to newer product type, higher quality, that's consistent with what we're hearing and seeing in terms of where capital is flowing. But you could see, the prices range from, around 216 to as high as 262 a unit, with an average of about 228 a unit for that product type. There's a typo here in the 2010 vintage. I don't think there's a deal that sold for for 33,000. That was 2010 or newer. So that probably averaged out around 200,000 a unit for your 2010s or newer. And you could still see, like, depending on location, there's some deals that are trading upward, across our markets for 1990s vintage, north of 200,000 a unit if it's well located. So the market is there. I'd say what we're seeing in terms of trends, there's capital that wants to be deployed. There's still a focus on quality. The ability to acquire good assets at a relatively attractive basis. I think in the right locations, there's bids there for it. It's being disciplined and having to go through an exhaustive exercise to get to, for like our size shop that wants to do 3 to 4 deals in a given year. Again, at this pace, we'll be through probably 200 to 250 plus deals that we've screened in some capacity to get to those 3 to 4 deals that we close in 2026.